be able to share with you the transcript, the transcript as well as the recording whenever you need it. So they've recorded the webinar, and in future, whenever you need it, Grace will be able to post it for us and show you. Thank you. I'm going to switch off the camera. Okay, hopefully you are able to see my current screen. It is our PowerPoint where we are going to highlight what we're going to go through. Okay, I've introduced you to the calendar. So the calendar is online. And like what I've indicated, there's a forum which will be available on a weekly basis, but also I log in. Hello, let me try to mute all. Okay, and then announcements, they are there. Our manual is found online on the introduction tab. And also the other thing is that you need to download the Act, the Legal Practice Act, and the rules of the LPC. Those are very crucial. You need to know your Act, especially the sections that pertain to accounting. So they have sections like from section 86, and also they've got accounting rules in the combined rules. So you need to download, and when you are going through our manual, you'll find it has got reference to these sections and also reference to the rules. So you need to understand those ones. And then I've explained to you that we have a test, crucial test, which is test 1. And test 1 contributes 20% to our final mark. So make sure that you attempt it, you attend to it. And for those who do not understand how it works, please feel free to ask again. Like what I've indicated to say, you have an hour to attempt, but you can do it within the 1.5 months that you are given from the start to the due date, which is on the calendar. So for test 1, make sure that you attend to it. And then our test 1 is basically based on theory. It has got a little bit of workings, mathematics, which is more of like accounts based, but it's not that difficult that you would need a calculator or you would need a computer to calculate. And then our assignments, 3 major assignments, which is assignment 1, assignment 2, and assignment 3, they contribute 80% of our final mark. So we weigh the 3 assignments together and we take 80% from there. We combine it with test 1, we get the final result. And then when it comes to assignments, you can write them. You can write on a piece of paper. You do your T accounts, you scan them, you upload, or you can do them in Excel where you do your T accounts, you do your double entries, and then you upload. So when it comes to your Excel, the only thing that you need to be wary about is your formatting. So you'd find with Excel, if you do not define your pages or you do not do your page breaks, then the challenge with Excel is that you would find it creates a lot of pages which are not interrelated. So you should always ensure that you... Hello? Yeah. May we mute our mics so that we do not disturb other learners? Okay, yes. And then so you make sure, and then or you can do them in Word, and then you do your T accounts in Word, or in Excel, you paste in Word, and then you make sure that they fit on a page so that you do not lose marks because of formatting, because I know formatting usually is a problem. So when we are marking, we mark using a marking tool, and it's PDF based. It can only mark on PDF documents. So you can either you scan it. If you've written on a piece of paper, you scan it. If it's in Excel, you turn it into PDF. If it's in Word, you turn it into PDF so that we are able to mark your assignment. If you are not able, we are generous. We try to, like, if you submit and it's in Excel, we also try to download and then we convert it into PDF. So you would find if you give us in a format that is not markable, we then try to be nice, we convert it, and then we also then mark it in PDF. So you'd find when we are bringing it back to you, you'll be like, oh, this is not my assignment, but it's because of the format that you would have given us. And some of the PDFs are kind of like locked. So you find we also try to find a way of removing it from being locked and then put it in a markable format, but it will be still PDF, and we then bring it back. And then the crucial thing, because this is an online course, you need to plan your time. So you need to check the calendar, plan your time. What we have tried to do for those assignments which are very difficult, we've tried like assignment 2, like what I've indicated, that it's a bit demanding. It needs time. We've tried to make sure that you can also do it over the weekend. And then probably when you come back to work, then you are able to scan and upload it. The challenge is with this load shedding that is happening, you would find if you do not plan your time, you would find time goes, and then when you try to upload last minute, you find there's a load shedding, or you don't have time at all. So just attend to your assignments on time. And then also what we have tried to do is whenever you upload your assignment online, you can upload as many times as you want until the last day. So if you have made a mistake, you can go and remove, you go back, you attach, then it comes through. Even if you do not remove, what we then try to do from our end is that we try to check the latest version. We try to check for the latest version, and then we mark the latest version. And the other thing is that I encourage you not to, like, when you are answering or when you are submitting your assignments, try not to submit question 1 on its own, question 2 on its own, question 3 on its own, or to do the cash book, you upload it, you do the, just if possible, number your pages from number 1 up to the last page, and then you scan them, or you make sure that they are in sequence, you upload as one document. And then when you do that, it's easier for us to mark, to quickly mark, and to add up. You find we use an online, we use a computer-based adding solution that they've given us. So it adds up the marks. So if you submit for me one document, one PDF, 5 PDF documents, I have to add them up. I have to put percentages for each and every one. So if I make a mistake, then it's a disadvantage to you. And like just using one tool, it adds up, and then at the bottom, it shows you your final result. Okay. So I encourage you to be active on the platform. Please keep me busy so that I can answer your questions. You find I would only know that you are there if you can go on the platform and you ask questions. So when you ask questions, we answer, and then you are able. And sometimes where you feel the examples are not enough or they are not clear, when you ask on the platform, we try to always add more information. Never give up. We are there to assist you. And the Law Society is trying by all means to make sure that we impart as much knowledge as possible. Hence, they've introduced these webinars to you guys. Okay, I'll move to the next slide. It's to do with the assignments. I think I have explained how the assignments are contributing to the final marks, and then how you need to practice, attempt, make sure you submit. Even if you have not finished, just submit. We'll comment and say, oh, okay, you have not submitted, but you would find it then gives a weight to your final mark. And then our assignment 1, it is going to cover chapters 1 up to 7. And also on the assignment, we'll also highlight to say it is covering chapters 1 to 7. As you know, accounts management, it's more of like bookkeeping. It's just bookkeeping and a bit of accounting at the end. But because it's bookkeeping, you find it needs a lot of practice. So whatever that we are going to give you, it will turn out into ledgers as well as cash books that you need to draw up and we need to post. So even assignment 1, it will have a little bit of theory, and then it goes into our practical part of our course. And then assignment 2 covers chapters 8 to 13. Chapters 18 to 13, they are more like technical, a little bit difficult for, say, advocates, but for attorneys, I guess, it will be more of like what you do on a day-to-day basis, but it's still our bookkeeping concept, but we are now introducing more of like your legal concept, which is your conveyancing. We are introducing your investments. We are introducing your correspondence. So we just want you to apply, and also the VAT. We just want you to apply in a given person according to the way that we would have applied in the manual, as well as in examples that we are going to do. And then assignment 3 will cover all chapters. It's a simple one. It will more of like try to cover up for assignment 2, which I know most people complain about. We don't want you to fail the course, so assignment 3 will try to cover up. It will be more of like in a different kind of like style. Some people you find they lose out because of the style, but it's still accounting and you have to apply the same concept. So you need to ask on the forum, and then we attend, and also on the webinars. Whenever you have questions, you put them on the forum, then when we come to our webinar, then we answer. Okay, so our manual, it takes us through the introduction which I have basically given you. This course is called Accounts Management, and it is the same as the legal bookkeeping course, more of like the same. We used to call it legal bookkeeping course previously, so they just changed the topic. Hopefully it does not confuse you, but it's more of like an introduction. Once you have done it, you find when you go to your PMT, when you go to your practice management or your board courses, you'll be doing literally the same. Okay, and then you need to study the manual, and then also in our manual, you find the manual introduces more the trust and business accounts. So because we are in the legal fraternity, we run a trust account, and also we run a business account. So a trust account is basically structured such that it is to hold money for our clients. So when we are doing our bookkeeping, we have to separate our trust account from our business accounts. So with business accounts, you would find this now relates to the practice, how the practice is to do their bookkeeping, as well as their reporting, as well as attending to their taxes. So usually the two, they should not mix. So you'd find if you are having any accounting softwares, you would find you will have an accounting software that deals with the trust account on its own, and then you have an accounting software that deals with the business account. There are some accounting softwares that mix the two, But in mixing the two, you find then they teach you how to ensure that trust transactions remain trust transactions and business transactions remain business transactions, because they have to be separate. So you need to have a thorough understanding of trust and business accounts, how they should be different, how they should be separated. You'd find in your rules, in the Act, they stress that the two should be separate. So you should not mix the two. So trust funds, business funds, they should not flow together. They should be separate. Only funds can only flow where there's documentation, as well as where you have a legitimate reason for you to transfer money from the trust account to the business, like where your fees are due, and then you have recorded your fees in the business side of things, then you are able to take your fees. Okay. So our first chapter in our manual, it deals with the basic control principles. So it's more of like stressing on the rules, as well as putting more emphasis to some sections of the Act that deal with bookkeeping and accounting. So you need to go through. I'll more of like try to go through a bit so that I don't take much of your time. But if you can go through the chapter 1, you'll be able to understand. Where you don't understand a certain rule that you do not understand, then we can always post on the forum, and then we can discuss it together, or I can answer. And if anyone has got another explanation, they can help us with the explanation. Okay, and then our trust accounts are more of like explained in the Legal Practice Act from section 86. That is where they stipulate where we find our trust accounts. So the major trust account, which every legal practitioner should have, is referenced to section 86.2. So when you go on section 86.2, it will tell you that for you to become a trust account legal practitioner, you need to open a trust account with a bank, recognized banks. There are certain banks that they recognize that the Fidelity Fund has already made an arrangement with, and they've structured the bank charges, they've structured the interest. So when you go and open your trust account, it's more of like structured. And then also section 86, it also explains the investment accounts. Section 86.3, it gives us, there's an investment account, which is more of like a call account, where they say whenever a legal practice is having excess funds in the trust account, they are not in use, like if there are funds where you don't have instructions from your clients, then those funds, you can take them, put them in an 86.3 call account, which is immediately available. And when you create that call account, you should liaise with the banks. So the section also stipulates that it has to be opened with certain banks, and you tell the bank that may you open for me a section 86.3 account, and on the bank statement, it should stipulate that it's a section 86.3 account. So it's more of like for the benefit. When you invest in such an investment account, the interest is for the benefit of the Fidelity Fund. And also section 86.2, they've structured it in such a way, the normal trust account, they've structured it in such a way that you don't really need to open a lawyers.
We miss you there. You cut. We couldn't hear what you said. We were talking about section 86.3.
Okay, section. Can you hear me now?
Yes.
Okay, so I was saying that with section 86.3, it's an investment account. So this one is to the discretion of the firm. Whenever the firm is having excess funds, excess money, and there are no instructions from the clients. Then the firm can, on its own accord, go to the bank, ask the bank to open. It's not a specific, you are not referencing it to a client. So you just say to the bank, may you open, I want to park some funds, trust funds, but you would find the interest that is earned in a section 86.3 is put back to the fund. It's transferred to the fund. There's no benefit which goes to your client. There's no benefit which goes to the firm. All the interest, just like a section 86.2, goes to the Fidelity Fund. And then we've got a section 86.4. 86.4, this one specifically, you are given instructions by a client. So you have your client, you have an underlying transaction, maybe you are a conveyancer or you are into litigation, and then your matter is ongoing and you received money in the trust account in your section 86.2. And that money, you are specifically instructed by the client to say, while the case is ongoing, may you open an investment account so that the interest that is earned in that investment account will come back to me as your client. So what you do is that you go to the bank or you phone your bank, your banker, and then you instruct them to open a section 86.4 account, and it should stipulate like it should be per client. Each client should have their own section 86.4 so that the interest, you are able to trace the interest to a particular client. And then what happens with that, it has got its rules. So you'd find when you go through the basic controls, it will give you when to open, that you should have instructions, the money should come back into trust account. And also you'd find the Fidelity Fund has made arrangement with the banks, so they are able to withhold. There's a 5% of the interest earned that goes to the Fidelity Fund. So you'd find most banks, they are now on a sweeping system where they automatically take that 5%, they pay it over to the Fidelity Fund. So say, for instance, if you do not do that in a section 86.4, then it means if the bank does not do it for you, you have to do it yourself. Then before you can close the account, before you can pay the client the interest, you have to ensure that 5% is paid over to the fund. If you do not do that, then you find you pay out of your own funds. So those are the basic controls, so you can go through them and then you check. And then also on the basic controls, we've got other statutory requirements that we have listed. So you find for a legal practice, you have to register with FIC, with FICA, we normally call it FICA, Financial Intelligence Center. You need to register with them. And then there's a reporting obligation where you need to report to the FIC. If you receive money from your clients in cash and the money is above 25,000, then you need to have a look at that, see how you report to the Financial Intelligence Center about those, the funds received. And also you need to figure your clients, you need to know your clients. It's more of like knowing your clients so that we avoid money laundering. And then the other statutory requirements that we have, it's your, if on the business side, if whenever a firm is having employees, then it has to register with the South African Revenue Services, SARS, register for pay as you earn, register with the Department of Labor for UIF, register for compensation, the Workers' Compensation Fund. There, when your employees are injured at work, then you are able to claim. So you find now those departments are now cracking on attorneys. They are now cracking on legal practices. Like now I saw a recent email which they have sent out to say, like SARS, they've sent out an email to say, we want a database of all the legal practitioners that are in the records of the LPC. So you'd find on your own accord, there's no one who teaches you that you have to now register for tax. So you need to know the statutes. You need to know when to apply for VAT, when to register for pay as you earn, and you need to know when to pay your income tax. So when it comes to your income tax, if your legal practice, like for attorneys, they're allowed to register a company. When it's a company, an incorporated company, when are you supposed to pay tax? What is provisional tax? When do you pay it? When do you prepare financial statements? When do you submit? When do you engage your bookkeeper to make sure that all your submissions are done? So you need to learn all those other statutory requirements. Okay, so when you go through your manual, you will find all the other statutory requirements under the basic control principles. Okay. I hope I have covered a lot for you. And let's go to introduction to bookkeeping. I'm not going to touch a lot on bookkeeping. Hopefully you understand the principles, you understand the concept. They are there in the manual. So please just go through the manual. So you need to know the difference between bookkeeping and accounting. So bookkeeping, basically, it's your recording of transactions from your source documents. You record your transactions from your source documents, and then accounting, after recording, it's an extension of bookkeeping. Now you go an extra mile, you account to a third person. It can be also for your own benefit, because now you are pulling reports. You are now looking at the reports. If they are required to be in a certain format, you pull them in that format. Like with SARS, they require you to have an income statement. They require you to have a balance sheet. They require you to produce your ledgers. So your ledgers that you are going to produce are basically going to come up from your bookkeeping. You have recorded, you come up with ledgers, you prepare financial statements, you report to SARS, and then when it's the LPC, you record your transactions in the trust account, you give them to an auditor, you give your ledgers and your cash books to an auditor. So you're accounting, now you're accounting to a third party. The information that you have processed, you are now relaying it to a third party. And then you need to have a look at the importance of bookkeeping. So you find, in our case, because we are required to account to third parties besides the firm itself, so we need to look at the importance of us recording the books accurately and completely, you see. So you find some of the importance are that then you know your assets, you know your turnover, you know your debtors, who is owing the firm. So the best way to do your bookkeeping that I recommend is more of like, if you're doing it on your own, the best is to more of like use an accounting system. You can use Excel. Excel is more involving. You need to know your formulas. You need to know how to capture from here to there. But the best is to use an accounting system like Sage, like Xero, like, yeah. And also there are specific accounting systems that are designed for bookkeeping. So those ones will make your life easier, unlike recording manually. Okay, so if you are doing your things manually, then you need to learn the principle of debits and credits. That is our double entry system. Our double entry system basically says what you have debited should be credited in a certain account. So if you have a particular, each transaction should be recorded twice. Each and every transaction that occurs in the firm should be recorded twice. So when I'm saying a transaction, no matter how small the transaction is, it has to be recorded, because when we record these transactions, then they give us a clear picture, an accurate position of the firm, an accurate position of our debtors, our creditors, our assets, because these records, we have to keep them. They relate from one period going into the next period. So we need to also keep our records. So whatever that you are recording, you need to make sure that you keep your backup. When you keep your backup, it will assist you. Like what I've said, you need to account to third parties. You need to account to SARS. SARS can come back to you and say, okay, you have submitted your financial statements, you have submitted your returns. May you give us your records for the past 3 years. So you cannot go back and say, no, I don't have records. You need to have your records. You need to keep them. You need to back up. And they normally say you need to keep your records for 7 years. Now they are saying 7 years. It used to be 5 years. So you need to check on each and every act. Like the Tax Act, I think it says 10 years. So the thing is that if you submit your records and they come back to you and then they see that there's something significant that they feel they need to query, you need to then have. So when you are doing it manually, usually it's very difficult then to keep your records. But if you are doing it manually, then what you then need to know is that you do your principles of debits and credits to each and every transaction. Okay, and then the next thing, what we have what they call an accounting cycle. An accounting cycle. So for each period, we are given a financial, what they call a financial year, or an accounting period can be on a monthly basis. You record on a monthly basis, you balance on a monthly basis. Like now, you find the LPC, the rules, they say you have to keep your records on a monthly basis, which means for that accounting cycle, that 1 year, or sorry, for that 1 month, you need to download all your records to show that you are recording your books on a monthly basis and you are up to date. So whenever they come for an audit, then they check that. And then financial periods or financial years, these, like for individuals, we have to run on a 12 months basis. And for individuals, we start from March up to February. When I say individuals, it's our sole props, our partnerships, where we haven't registered a company. So if it's a company, usually the company, when you are registering it, you have to stipulate the financial period for that company, which is your 12 months period that you are going to run. Okay, and then also we've got trust audits, like what I've said. With the trust account, you have to have it audited on a yearly basis, present it to an auditor, then the auditor with yourself, you present it to the LPC. So you should always ensure that your trust account is audited. For those ones who are going to start their practices, they are given the first 6 months, they have to perform an audit. You perform it for the first 4 months, but you are given to do it within the first 6 months. So you need to ensure that you have appointed a bookkeeper, or if you are doing it on your own, excuse me, then you appoint an auditor and then you have an audit done, you submit. So the thing with trust audits is that you find the LPC, they penalize if you do not submit on time. They give you, like for a normal yearly audit, you are given 6 months after the year end to submit your audit. Okay, let's move on. So our next, the next topic talks about what is trust money. So it's more of like now your trust and business principles, trying to explain to you what is trust money, what is business money, how do you identify trust and business transactions, and then what are trust creditors, what are business creditors, and what are composite accounts. So your trust money, it's basically money that is supposed to be kept in a trust account. This is money It can be for future fees, but it's not money that is due to the practice as yet. So as legal practitioners, we are allowed, you guys are allowed, I am an accountant, so you guys are allowed to ask a client for a deposit. If you feel like you're going to run a matter, and with that matter, your client, you can't trust your client, or when you present your invoices, then collection becomes an issue, then you are allowed to ask your client for a deposit for the matter. So you can estimate and say, okay, if I can get a deposit of 50,000, then I'll be able to run with the matter probably for 3/4 of the matter. And then what you do is that with the money in the trust account, you then invoice your client, present an invoice. Once you agree, you can transfer money from trust to business against that invoice. Okay, and then the other trust money, it's your money that you're holding on behalf of a client. So it can be for a litigation matter where your client is supposed to pay over some money to the other party. So then they say, okay, we need to keep that money into trust. Then you receive the money, keep it in trust, and then make sure that you account for that money. Or it can be money for conveyancing, where you are receiving from the purchaser before the property can be registered, and then you receive money, you pay for all the other expenses and ensure that you obtain all the required certificates. And then after that, when the property is registered, then you pay over the money to the seller and to the estate agents. So it's more of, you are trusted with the money, and the parties are not worried to say, when the property is registered, what is going to happen to my money? So that's basically our trust money. And then business money, it's money that belongs to the firm. At the end of the day, you find we have worked hard. We are to be paid. When we transfer money from the trust account, then it comes to your business account. Then it becomes money which belongs to the business. And also, when the owner or the legal practitioner brings in money into the business account, then that becomes business money. And then what we then do with that business money, we have to account for it. We have to then do the bookkeeping, we account, we pay our creditors, we pay over money to SARS, we make sure that we save. So with business money, you can have a business account, or you can have an investment account, a savings account, an instant call account, so that you put money aside for the future as well as for the obligations of the firm, to ensure that you pay your salaries, you pay your rentals, and also as the practitioner, you take your drawings as well as taking your salary if you have designated a salary. So that is your business money. And then when you go through this course, you should be able to then identify trust transactions, and then you should be able to identify business transactions. The reason why you have to be able to identify is because the rules are very stringent. You find the LPC, they can send in investigators, they come through, or inspectors, they call them inspectors, they come through, they want to inspect your books. So when they see that you are mixing business and trust money, then you'd find it's a contravention of the rules. And in your profession, you'll find you get fined. You go for disciplinary hearing, you get fined for keeping money where it's not supposed to be kept. So they're more of like they are strict in that if a client deposits money, trust money in your business account, of course errors do happen, we are humans, then you are supposed to then ensure that you transfer your money from the trust account, from the business account into your trust account immediately. Or the moment you identify that this is trust money, you ensure that you transfer it into trust from your business account. And it's the same with business money. They normally do not encourage attorneys to keep their money in the business account, because they know it's a loophole for you to run away from taxes. So you can always take your money whenever you need it. So they encourage you to ensure that whenever money is due to the firm, transfer it to the business account, to the taxman, pay your creditors, and if you've got surpluses, then you put it in an investment account which relates to the business. You know, as any other business, we have to ensure that we account for our taxes. So usually those are the ones that scare us. Okay, and then our trust creditors are basically limited to those people that have put money in the trust account. So if a person has put money in the trust account, or they've deposited money in the business account, which is trust money, then it's supposed to go to the trust account. So we limit our trust creditors. We can't pay someone or pay expenses for a matter for someone who has not put in money in the trust account. So say a client is supposed to pay the sheriff, and the sheriff says, okay, pay now, I want to go. So, and the client has not given a deposit. In such a matter, then you find in such a circumstance, then what we have to do is to borrow the client. And where do we borrow the client? We borrow the client from the business, and then the client becomes a business debtor, is owing the practice for what we have paid. So if that particular client then happens to pay money into the trust account, the firm is allowed to transfer money from the trust account to cover that disbursement that they've paid on behalf of a client. Okay, so our trust creditors are limited to those clients that have deposited money into the trust account. And the other thing is that the trust account, the banks, they collect their bank charges from the trust account. So when they are collecting their bank charges, you'd find sometimes it goes on an overdraft, or then the bank charges, it causes the balance to be less than what we owe the creditors. In such a case, then the firm is supposed to ensure that it puts in money. But what the fund has done and the LPC have done is that they've introduced what they call the sweeping system. So the sweeping system, if you tell your bank, I want to be on a sweeping system, the bank will ensure that month end, they will present the bank charges in the trust account, and immediately they will sweep them over to the business account. So they are more of like recovering the money from the business account into the trust account so that there is no deficit. And also, when you are on the sweeping system, then they manage the interest for you, because interest is supposed to, the net interest and less bank charges is supposed to go to the Fidelity Fund. So they manage that process for you. If ever there's interest that is due to the Fidelity Fund on a monthly basis, then the bank sweeps it takes the interest over to the Fidelity Fund. And also what they've done is to ensure that the VAT on the bank charges is recouped from the business account using that same system. So you should always utilize such a system so that you do not find yourself with a trust deficit where you are owing your creditors money due to bank charges or basically bank charges, because usually it's rare that they charge interest on a trust account. Okay, and then when it comes to our business creditors, it's your suppliers that you owe on the business side. Okay? So your business creditors would be probably your municipality, your landlord, if you are utilizing rental offices, and then your telephone providers, telephone service providers. Those are your business creditors. So they are paid from the business account. Your employees are paid from the business account. You can't pay employees from the trust account. So when it comes to your trust account, you have got your fees which are in your trust account. They relate to your client ABC. So what you do is that when you transfer those fees into your business account, you have to reference them so that they show that these are fees for ABC. So it's not like whenever you feel like, okay, now I want to pay rent, I want money from trust, you go to a trust account, you transfer, and your bank account reflects that it's rent money. I'm taking my money, it's rent money. No, it shouldn't be like that. It should always relate to your trust creditor who has put in money in the trust account. And it should be clear so that if a third party is supposed to do your bookkeeping, then it becomes so clear. And your composite accounts, these are instances where your clients pay in money into the trust account or business account. When you analyze that type of the money that has come through, you'll find it has got an element of trust money and it has got business money. So say, for instance, already you have invoiced the client and said, okay, now we've done your work, you are owing us 10,000. And then you can as well give us a deposit so that we continue with your money. And then the client decides to pay either in the trust account or in the business account, they pay 20,000. So then that we call it composite. It's called a composite account. So what you do, you then split it, transfer money back into the trust account, or transfer money that is due into the business back into the business account. Okay, so now it's almost 25 past 5. Let's take a 5 minutes break, and then when we come, we do the last 30 minutes.
Can you repeat? Hello.
And, yes.
Can you just repeat that one of composite what?
Composite accounts.
Yes, where the client pay 10,000 rand and the 20.
Okay, so composite accounts, the client pays both business money and trust money. You see, so say for instance, you have already invoiced the client, and then the client is not paid for your invoices, or you have already paid the sheriffs, you have paid the advocates on behalf of the client, and then all of a sudden the client pays in money that includes, but when you look at that money paid into your account, you can see when you cover your business expenses or your fees, there is still money that is left that belongs to the client. You haven't accounted for that money. So then we call it composite accounts. What you have to do is you then have to take out the component that is what trust money. You transfer it into the trust account. You hold it in the trust account until you have what the need, or you have raised an invoice, or you want to pay an advocate, or you want to pay a sheriff, then you can transfer it back into business for you to cover the expenses. If it's your fee, you transfer, you take your fee. If it's the sheriff and money is in the trust account, you just pay the sheriff from the trust account. There's no need for you to transfer money into the business account because the money is in the trust account. You just pay the sheriff from there, you just pay the advocate from there. No need to transfer the money. So those are your composite accounts. Hopefully it's clear enough.
Yep.
Okay, so let's take a break. We'll be back. Let's come back after 5 minutes, and then we continue and finish the last 30 minutes.
Ma'am, sorry, can I quickly ask? Sorry, ma'am, can I quickly ask a question, please, before we take a break?
Yes.
In the case of an advocate,
Yes.
when the attorney pays an advocate, is he paying? I only want to make sure about this. Is it being paid in the account of an advocate, in the business account, or in his private account?
When an attorney pays an advocate,
yes.
So the advocate will present you with an invoice.
Yes.
Okay? Yeah. So usually advocates also, they are required to open business accounts, if I'm not wrong. But with advocates, usually they can either use a personal account or a business account. But when an attorney is presented with an invoice, usually they pay into that particular account that they are given by the advocate.
Okay,
Yes.
ma'am, I only
But
want,
what I know is that there's a need to open a business account for an advocate where you trade from the business side. Though you can use your personal account because you are more of like a sole prop, you are a sole practitioner. Yes, because you are a sole practitioner, you can use your personal account, but when it comes to accounting, then your obligation more lies with what accounting to SARS than
yes,
accounting to.
that is why I asked the
Yes.
question. I'm sorry for the other attendants, but I keep you busy. I know we want to take a break, but I think it's
Yes.
easy in my case. It's easier to pay when the attorney pays you in the business account because why when you do your tax,
Your invoices, yes.
your invoices, it's easier to work it out of a business account than out of your private account.
Yes, it's easier that way too, because if it's in your private account, it means then you have to separate your personal
Correct.
expenses from there, and then after separating your separate expenses, then, or if ever you have a bookkeeper, then you have to sit down more with your bookkeeper and explain to say, no, this is business, this is personal, this is, so it's best to have a business account. From the business account, then you can draw, usually they call it drawing, you draw your funds into your personal account, and then from your personal account you can pay for your personal expenses, and then from the business account you can pay for business expenses, because you as advocates you have to pay for the bar, you have to pay
Yes,
for,
yes.
yeah, for your creditors, your, I mean, if ever you have you want to put in fuel, you pay from your business account. Whenever you want to pay your telephone charges, you pay from your business account. And also, like, there are some advocates, and now there are some advocates who have registered to have trust accounts. So
Correct.
those advocates that are required to have trust accounts are supposed to open a business account as well.
Correct. That's right.
Yeah, because
Ma'am,
that is a requirement of the LPC. Those are part of the rules to say every legal practice which has got a trust account is supposed to have a trust and a business account.
that's correct, ma'am. Ma'am, thank you very, very much.
Okay, you're welcome. Yeah, let's take our break, 5 minutes, and come back. Welcome back, welcome back. We need to continue because what I've realized is the 2 hours that we are given for our online bookkeeping, our accounts management is not enough. So you'd find that's why I seem not to be entertaining questions. I continue, I run just like that because there's a lot to be covered. So hopefully I'm covering most of the things. Okay, yeah. I've checked on the questions. There was a question on the size of the PDF that you have to submit for your assignments. Yeah, so the system, it appears it can take up to 10 megabytes. So if you can see that your size is now too big, probably that's when you can submit that's when you can submit a second attachment, but it can take up to about 10 megabytes or even more. It's kind of like not limited. And where you see that you have to submit a little bit bigger, you can then talk to Grace, and then Grace will be able to assist you. Okay, and the recording, I see a question on the recording. Yes, the recording will be made available. What they do is that they check for quality and see if it was properly recording and everything is clear. And then after that, they upload it on the system. I think a part of our recording, probably the first 10 minutes or 30 minutes where we were doing the platform, might not be available because I started recording a bit late. But the important things pertaining to the course, yeah, those are available. Any other questions that you might have? before I can continue and finalize on the course material. Selo, do you have any question? Okay, so I'm going to mute all and then we continue. I hope everyone is here and you are not affected by load shedding. Okay, I'm going to continue with our accounting records. Okay, so our accounting records, we start with the source documents. So our source documents, nowadays, it's like your bank statement. Your bank statement is the major source document. So you need to have a system which makes you access your bank statement. I recommend that on a monthly basis, when you receive those bank statements through email, you have to backup, save them, open a folder on your laptop, or if you're the printing type, then you print your bank statements, you file them, you make sure that you have them, because that is your major source document that you need to have. And because now checks, I think last year they've come to realize that checks are expensive and then they've done away with checks. So checks are no longer our major source documents. We used to rely more on checks. So we need to have our bank statements and also our receipts, our receipt books. So for our clients who bring cash in the office, you need to have a trust receipt book and you need to have a business receipt book. With the trust receipt book, when you receive your money, you ensure, then you deposit it into the trust account and you put a reference that relates to your client. And if it's your business money, you also do the same, receive it, deposit into the business account, and then relate it to the client that is paid. And keep those source documents, because when the inspectors from the LPC or the Fidelity Fund come for inspection, you find they ask you for your receipt books. And when you are using accounting systems, there are some which can allow you to receive money and be able to issue receipts, but you would find systems like Sage, they allow you receive money on your bank statement, and then the moment you allocate onto your accounting records, automatically a receipt is created. So if you have a system like that, it's rare that you find the LPC, they request for receipts because they know that the receipts are automatically linked to the accounting records. And then the other source document would be your invoices. So when it comes to your invoices from the firm has to issue invoices. I know usually firms, they call invoices statement of accounts. So when you create your statement of account to a client, like one of the rules is that a firm should account to its clients. So you should generate invoices, you should generate statement of accounts. You shouldn't just take money from the trust account and say, this is my fee. You should show proof that that money belongs to the firm by creating an invoice or creating a statement of account. And when the firm is registered, or the legal practice or the advocate is registered for VAT, then you find from SARS point of view, they want that invoice to be written tax invoice, and then you show the VAT amount that is charged to the client. Okay, so your invoices from the firm side. If it's a system, if you're using a system and you back up your system and you keep your backups, there's no need for you for one to print invoices. Whenever you need them, you can always download, or you can download and then you can send to the client, or you can download and then send to whoever you're accounting to. And then invoices from your suppliers, you need to collect invoices, file them in your accounting files, and also record them, because they are a source of information for us. So you'd find if you're using an accounting system, then you can record your suppliers. But if you are trading on a cash basis where you pay your clients cash upfront or you pay them as an invoice is presented, then there's no need for you to create suppliers, because the suppliers, it would be a lot of work for you to create suppliers. So what you do, you make your payment through the cash book, and then the next thing you post your transaction, whether to the expense, to the asset, if it's an asset that you are buying, or if it's a payment on behalf of a client, then you post against the ledgers. Okay, so those are your source documents. You really need to keep your invoices, even petty cash. You need to keep your petty cash invoices, your fuel invoices. We know these days we are swiping a lot, so collect your invoices. Because one day if SARS knocks and say, we want to verify your invoices, then you should be able to present even the smallest of all invoices. It can be for a meal, you're coming from a client, you're hungry, you go for lunch, use the business account, collect your invoices, file them, and allocate so that you are able to account to a third party. And then from your source documents, then you have to record into books of prime entry. Our books of prime entry, if it's our bank statement, we record everything which is on the bank statement on our cash book. So you'd find these days the bank statement is very crucial, because that's what we more of like use to record our cash book. But if you are somebody who knows accounting very well, then you can record as people pay. If a client says, I have transferred, yes, proof of payment, then you can record. Then the next thing is for you to then check against the bank statement if the payment has gone through. If you have paid, the moment you swipe, you are given an invoice, you can record your transaction in the cash book. And then you check with your bank statement to see if that transaction has gone through or it has not gone through. Then it helps you, the cash book and the bank statement help you with controlling the transactions. So it will be more of like an internal control measure than just relying on what is on the bank statement. Because you would find if a client says they have paid and you are not aware, then it becomes a problem. Okay, and then from the books of prime entry, the other books of prime entry, we have our journals. So our journals are the ones that we use, like where we are not recording cash transactions. So say, for instance, we buy something on credit, we are presented with our credit agreement, then we have to record our transaction we keep a journal book where we then do the debits and credits in our journal book, so that when we take over those transactions, then we can combine them with those ones which are coming from the cash side. And the other books of prime entry would be your sales ledger. So you can record all your invoices in one book. And then at the end of the month, you post your transactions, or you can record your receipts. If you are receipting manually, you can have a book where you capture in the date, the client, the receipt number, and the amount. And then at the end of the month, you post to your ledgers. Okay, if you are doing it manually. If you are using an accounting system, then there's no need, because the system will automatically post for you. And then your ledgers are usually generated from your books of prime entry. So like what I've said before, accounting or bookkeeping is based on a principle of double entry. Double entry, your debit, your credit. So when you post something in your cash book, obviously you post one leg of that transaction, one leg of that transaction. If it's a receipt, then it is going to increase our cash. It is going to be on the debit side, and then the credit side has to sit somewhere. So if we are receiving money from our client, we receive in the cash book, and then we are going to credit our client to reduce the client's balances. So we need to have our ledgers. So at the end of the day, when you are being audited, when you are accounting to a third party, which is like SARS, they require ledgers. So ledgers, it's basically if you are having your telephone lines, all your telephone transactions for that particular month, or your telephone transactions for the particular year, you find them in the telephone ledger. All your fees for that particular month or particular year, you find them in the sales ledger. All your bank charges, they are recorded in the bank charges ledger. So a ledger groups transactions by their nature, their with the way that they are described. As you know, in accounting, our expenses, we split them according to category. If it's a bank charge, accounting fees, so that at the end of the period, then we are able to come up with balances. Then we would say towards telephones, we spent so much. Towards subscriptions, we paid so much. Towards motor vehicle expenses or our fuel for traveling, we spend so much. So that information comes from our ledgers. And then from our ledgers, we've got our trial balances. We generate a trial balance. And then our trial balance is a summary of all the ledger accounts. Because we are doing double entry, at the end of the day, it is supposed to balance. And then from our trial balance, we come to our adjustments. Then we prepare our financial statements. So our adjustments are basically like if we have assets, then there are accounting principles where we say we have to depreciate, we have to write off, and also where we see that we've made a mistake, then we pass an adjustment, and then that is done after looking at our trial balance. Okay, and then the financial statements, that is what we present to the people that we are accounting for. It can be SARS, it can be our partners, and then we have an overall outcome for a particular financial period, which is shown in the financial statements. And then from there, I'll move to our cash book. Cash books and ledgers. So our cash books for every account, trust, it can be trust or business account that we open, we need to have an independent trust cash book, business cash book. If we open a trust account with Nedbank, another one with FNB, then we open a second account with FNB, another one with ABSA, then it means we are going to have trust cash books for each account that we're going to open. And the same applies also to business cash books. We create cash books. This is done so that it's easy for us to balance. So you'd find if you combine 5 accounts into one book, it will be difficult for you to balance to the various bank statements. So it's advisable for you to then create cash books for each account. And in our trust cash books or business cash books, we record all the cash transactions. When I say cash transactions, it's your transactions that will go to the bank. Cash transactions that will go to the bank, that has to do something with the bank, like they are processed through the banking system. We record them in our cash books. So if a transaction does not go through our cash book, like our petty cash, we take cash, we go and buy at Pick n Pay, then that one we record it in our petty cash book because it is not going to be recorded at the bank. So our trust cash book, business cash book, they relate to transactions that go through the bank account. And then petty cash, the money that we have, we buy smaller items, we record in a petty cash book. So usually with the petty cash, we withdraw money. Say for instance, we withdraw money from a business account, or say a client comes and pay in cash, we take that cash, we return it for petty cash, then we have to record to show we've received money from this client, and then what have we used the money for, then we record in the petty cash book using the invoices. Okay, and then from our cash books, That's where then ledgers are generated. The transactions in our cash books, they assist us in generating our ledgers, because the cash book can only carry one leg, and then the ledger is the one that records the other leg of the transaction. And then our ledgers, we've got ledgers for income, we've got ledgers for expenses, we've got ledgers for assets, and then we've got ledgers for liabilities. So when we are recording our transactions, we should know what is an expense, what is an asset, what qualifies to be an asset of the business, what qualifies to be a liability. The reasons why the ledgers are demarcated as such is because when we present our financial statements, or when we present our ledgers for tax purposes, there are certain things that they will tell you that this is an asset, it's of a capital nature, it should not be part of expenses. So when you are studying the manual, please check what is an asset, what is income, which one is business income, which one is other income, and how is it recorded. And then at the end of the day, what we do is that we reconcile our ledgers, we reconcile our cash books. How do we reconcile our cash books? We reconcile them against the source document. So in case of cash books, we reconcile against the bank statements, and then we achieve accuracy, we achieve completeness. Okay. And then I have an example. Like our assignment 1, we have to record transactions in a cash book and a trust ledger, but I see we are now left with about 5 minutes. So you'd find, I don't think I'll be able to present the whole transaction and record it for you and help you to record the transaction. So maybe what we can do is that we can, for those who want to stay in for another 30 minutes, then we can do like vote, raise your hands. We see those who want to stay for another 30 minutes, or we can then arrange for about another hour where we then just come and attend to a cash book. But for those who are like, if the majority of you know how to record transactions in a cash book and in a ledger, then there won't be any need for us to do the example. So I'm just going to open, since we are about to finish. We see if the majority says we do 30 minutes, then we do 30 minutes, and then, yeah. Okay, so for those who say we should do another 30 minutes to record, or those who want to stay for the 30 minutes, you may raise your hands. You may raise your hands. Okay, so it appears the majority are raising their hands, and you want us to just record some transactions in the cash book. So for those ones, because we have other appointments, since we are going to record, we are recording the webinar, and you feel like you want to leave, you can leave, and then you will come and have a look at the probably last 30 minutes of the webinar end. And then for those who want to stay in, let's quickly record this transaction so that I show you how we attend to our double entry recording. Yeah. Okay, I hope you are still. I'm still sharing the. I'm still sharing the question. So in our question, it says we should record the following transactions in a trust account. We should record the following transactions in a trust cash book and in a business cash book and balance it off. I won't reach to the balancing off part, but I will more of like just try to show how to record in a cash book. And then in the we have got our transaction, which is 1 August 2021. We've got an opening balance of 5,000. So this is our trust account. So we are given transactions which went through our trust account. And then we are told, okay, we've got an opening balance, and then we want to show. Okay, what I'm going to do, I'll pull in my Excel spreadsheet. Okay, hopefully you are able to see. Okay, okay, there's a question. Question says, do we need to know these acts off by heart? Will we be tested on them? Okay, so when it comes to acts and rules, we won't test that much on them. We've got a little bit of theory, but you find the acts and rules are good for you. They are good for your for your practical life. When you are attending to your practice, you need to know them because I have worked at the LPC. They apply them. They apply like they can say that you are in contravention. So yeah, you need to know them. Okay, so I'm going to share my screens. Okay, so what I've done is I've split, I've shown the other side has got the question, and then the other side has got where we are going to put our answer. Okay, our first transaction says 1 August, it's a opening balance of 5,000. So our trust cash book, it's recording our asset, and our asset here is our cash. So our assets should have debit balances. So if whenever we are receiving money, we are increasing our assets. So anything that happens to increasing our money or increasing our assets, we increase on the debit side. So with the cash book, the nicer part, then it has got a receipt side, which is our debit side, and then it has got a payment side. So when it comes to payments, then we are reducing our cash position. What we do with payments is that we post them on the credit side, on the right side, and then our receipts, we post them on the debit side, which is to the left. Okay, so our first transaction, we've got an opening balance. So which means we had money in the trust account. A trust account, this is more of like an asset. When we have it in the firm's books, it's more of like an asset, which more of like is not an asset of the firm, but it is an asset because it's cash. And our clients, we call them creditors, then they are recorded on the credit side. So in this case, where you have a folio number, then you record your folio. So your folio can be referencing, if you want to reference your transactions, so that you do the double entry. Remember, we spoke about double entry. So if we are recording our transactions, we should record them in such a way that they've got the debit and the credit for each transaction. Okay, so our opening balance, we've got an opening balance of 5,000. Then we come and show our date is the 1st of August, and then description, it is our opening balance, and the amount is 5,000. So usually what happens is that in this case, I'm just going to show you where we are given more information. So we are supposed to be told to say this 5,000, whose 5,000 is it? So if the 5,000 belongs to 2-3 clients, then what we do, we come to our ledgers. We create our ledger for those particular clients because we have to split the 5,000 into the various clients. So usually our opening balances, because we are taking from another period, then usually we have our creditors. We know that we've got creditor 1, 2, 3, 4, which make up the 5,000. Okay. So in this case, I'll show you how to record the 5,000. Because I don't have more information, I'll just show you how to record the 5,000 into our cash book. So it's an asset, it's a receipt, then it comes to the receipt side. And then on 2 August 2021, Mr. Govender deposited 50,000 into the trust account for a litigation matter. Okay. So 2 August, there is our date. And then who is depositing? It's Mr. Govender. And then we indicate that it's a litigation matter. The reason why we then say it's to give more detail, because sometimes you find a client is having more matters and you want to keep separate ledgers for each matter. So for the person who is following up, they are able to tell. With other firms, what they do a filing system where they give their clients reference numbers. So you find, then they put in a reference number. If Mr. Govender's file is M1101, then they would indicate M101, Mr. Govender. And then when you go to file M101, then you'll be able to say, oh, okay, this was a litigation matter, this was a conveyancing matter, then you are able to distinguish them. Okay, in this case, the trust account is receiving, our account is receiving 50,000. So on our receipt side, we record the 50,000. And because we need to complete the double entry, then we create an account for Mr. Govender. This is the debit side. It means we need to record for Mr. Govender on the credit side. So how we did, just gonna delete. How we do it is that we create a ledger. This is called a trust creditor ledger. For our client, which is Mr. Govender. I hope you are able to see, or I should enlarge a bit. But when I enlarge, then enlarge a bit, okay. And then when we record, it's on 2 August where we received. So because this is our creditor, we have received on the debit side. So with our creditor, we show on the credit side because the two should balance at the end of the day. We record the date, we indicate the corresponding account where the money was received. It was received in the bank account, trust bank account, and then we record our 50,000. So this is how we record a double. Like this, we have recorded our transaction. It's complete. It has got a debit, it has got a credit balance. Okay, and then we record our next transaction, which says on the 4th of August 2021, SAPS paid 40,000 into our trust account on behalf of Mr. Maluleke. So we start with our date, and then we've got Mr. Maluleke. We just indicate money is coming from SAPS, but we post to our client ledger. So our client is Maluleke. So we relate the money to our client, which is Maluleke. And then how much do we record? The 40,000 that we have received. And then after receiving this money, we have posted the initial leg of the transaction. Then it means we now have a new client, which is Maluleke. And then we have to create a ledger for Maluleke. So I'm just going to copy the template to make it easy. I'm copying the template.
Yeah, it's fine.
And then this is now going to be Mr. Maluleke.
I know when the power was out, even this morning when we got here, there was no.
Okay, Mr. Maluleke. So that is our client. I'm just going to delete the information that I have. And we received the money on 4 August. And then how much did we receive? 40,000. And again, it's coming through our trust cash book. So when we put this reference, then it says to us, if you can check in the trust cash book, you will find the other leg of the transaction. So it's Maluleke and the trust cash book. So this is how we record our trust creditors. Okay, and then our next transaction is 8 August 2021. We paid advocate Pantonte 10,000 on the Govender matter. So remember, we received 50,000 from Mr. Govender for his litigation matter. We have engaged an advocate, and in our trust account, that's where we are supposed to pay because the money was put in the trust account. So this is a disbursement that relates to our trust account. So we come to our credit side. I'm just going to delete everything so that I start afresh with you. So we record the date that we have processed this transaction, and the matter relates to our client. We always show that we are paying on behalf of Mr. Govender. And who are we paying? We are paying advocate. So when we do it like this, then you know Govender is our client, but we are paying advocate. And how much are we paying him? 10,000. So this is what I require from you. Please do not transfer money from trust to business and pay your advocates. When we are recording, we are supposed, like the rules and the act, they are very, very clear. They emphasize that where you have received trust money, pay the disbursement out of the trust account. So this is what I expect you guys to do. Record your transaction in the trust cash book, pay out of the trust cash book. Do not transfer it to business. When you get into the business account, then you pay the advocate. It's not done that way. Okay, and then we are paying the advocate on behalf of Mr. Govender. So here we have paid, our payments are on the credit side. When it comes to our ledgers, our trust creditors ledger, then we do the opposite. So it's our bank account and we are paying advocate. And how much are we paying? 10,000. So this is how we have recorded. Initially, we received 50,000, and for this particular client, we've got money in trust. We can pay on his behalf. We pay the advocate 10,000. So the idea here is that we are reducing our creditor. We are now not holding 50,000 on his behalf because we've paid the advocate. So posting on the debit side, it means we are reducing our creditor who has got a credit balance. Okay, and then our next transaction is 12 August. We paid Maluleke. Okay, we paid Mr. Maluleke 30,000 as a final settlement for his matter. So in this case, we are paying our client. We have agreed, okay, we collected so much, 40,000, but we are paying, we've agreed on 30,000. So the payment should be made out of the trust account. Therefore, it is recorded in the trust cash book. And then our date is 12 August 2021. And our client is Maluleke. And in this case, It's a final settlement for him. And how much are we settling? 30,000. Okay, so it's a payment on our cash book. It comes to the credit side. And then when it comes to our ledger, when we are recording, it's for Maluleke. We go to the ledger for Maluleke. We do the double entry. It's 12 August 2021. Description, it is coming from our bank account, and it is final settlement. And how much are we paying? 30,000. Okay, so we have, in this case, we have recorded the other leg of the transaction. And then we are told that on 25 August 2021, we transferred our fees of 15,000 from the Govender matter. So it would, when we are transferring our fees, then it would mean from the business side of things, we have raised an invoice. We have presented it to our client, which is Govender, and our client has agreed, and then we are able to transfer. So in this case, because it's happening on the trust side, I'm just going to show you how to record in the trust cash book. But if we are doing a bigger example, we are supposed to start with the invoice, go to the business side, we record the invoice, we then record in the trust cash book. Then we go back to the business side where we have received the money. Then we record to reduce our data, which is Mr. Govender on the business side. But in this case, I'm just going to limit it on the side of the trust cash book. And if I go to the business account and the transaction is there, then I'll show you how to record it on the business side. So it's on the 25th August 2021. It's still our client Govender, and in this case, it's our fees. Okay, and how much? 15,000. So we've paid. It shows that it was paid out of the trust account. We post it on the payment sides. And then we go to our ledger of Mr. Govender. We have taken our fees, which means the money that we owe to him in the trust account is now reduced by the fees that we have taken. So our date is on the 25th, and it's the bank account. We show it's a fee transfer. That how much? 15,000. So this fee is more of like being transferred into our business account. So if we are recording our business transactions, we have to then record transaction. Okay, and then the last one, on the 25th of August, we paid the sheriff 250 rands on the Maluleke matter. So we are still on the Maluleke matter, and we have to pay a sheriff. So the money is in the trust account. There's no need for us to transfer the money into there's no need for us to transfer the money into our business account unless if we are recovering our disbursement. So we are paying the sheriff because we had not paid the sheriff when we were running with the matter. And how much are we paying? 250 rands. Like that. And then when we come, we also record that transaction against the ledger for Maluleke. And we are paying the sheriff. And how much? 250. Okay, so this is how we record. So at the end of the day, we have recorded the given transactions. The idea here is for us to just be able to record transactions, to know how do we do the double entry. So what you should remember, all the money that we receive, when we create our trust cash book, we should have a receipt side and a payment side. Our receipt side we should receive all the money on the receipt side. When we do our payments, we should ensure that everything comes out of the payment side. Then we would say our trust cash book is properly recorded. And then the next thing that we need to do is to balance off. So I'm going to delete. So if you can have a look at our the transactions, what we do is that we add the bigger side. So when we add up, you would find this the debit side is what 95,000, and when we add up, the credit side is what a lesser amount. Then it means for us to balance off, we should have the same balance on both sides. So what we do is that we do our maths, we compare. You can do it using a calculator or your phone, then you compare and say, okay, the bigger side minus the smaller side, what is the difference? And then when you take that difference, that is going to be your balancing off figure. That is the figure that is going to move on to the next financial period, which is the next month. So in this case, it will be September 2021. So when we put in the amount like that, then both sides are balanced off. So this is what we call balancing off. So balancing off, what it does, it tells us that our bank should be sitting with what? 39,750. Okay, so when you do your bank reconciliation, you should then compare if your bank is sitting with 39,750 or not. If it is not sitting with 39,750, then it means one is to do a bank reconciliation and try to identify transactions which are not in the cash book or which are in the bank account. And then the transactions which are in the bank account should always come and be posted in the cash book. And then that one, we call it a supplementary cash book. And then when we do our bank reconciliation, all the transactions in our cash book and not on the bank statement are the ones that we take over to the bank reconciliation. You will see when you read on bank reconciliation, if ever you have queries, then we can always discuss that. Okay, and then when it comes to our ledgers, it is the same thing. We are supposed to balance them. We're supposed to balance our ledgers. So for us to balance our ledgers, we do the same. We look for the side that is bigger. So in this case, I am using technology. If you can't use technology, what you do is that you can always use your calculator. And then in this case, like if we look at the Govender ledger, you can see the credit side is bigger. It has got 50,000, but we have paid about 25,000, which means it is still having a balance which should be carried forward. Then we come to the side where it has got a less balance, and then we balance off. So we assume this is 31 August, there were no transactions, and then we are now balancing off. So we call it balance carried forward. We are now carrying it over to the next financial period. And for us to calculate our balances, we say the bigger side, which is 50 minus 25,000, then we are left with 25,000 that we have to carry forward. And then as you can see, then would say our account is balanced off. And then the Maluleke meter is the same. We come, we balance off, and we check. So until if we have not raised an invoice and taken our fees, the money will always remain as if it is client's money. We have to account. This is where the rules say we have to account. So how do we account? We account by raising an invoice or a statement of account, present to the client, we take our fees. So that is how we account. So this is how we balance off. I'm so sorry if I'm rushing you. It's only that 2 hours, it appears like it's a long thing, but with bookkeeping, you'd find it's not so so much long. So in this case, I am looking for the balance by checking the bigger side less the smaller side, and then what we put is our balance. That is how we balance off our accounts. And then from here, in our next, I'll be able to take you through on how to create a trial balance from balancing off. So you find your trial balance, you are now going through and say our cash book has got 39,000, and then our creditor Gavin has got 25,000, and then Maluleke, there's still 9,750 in the account. And then that is what you then take to your trial balance. Okay. And then the second part of our example, it's the second part is our business question, business account question. I hope you can see it. So the business part, what I'll do, I'll clear. We have to record in the business cash book and in the business ledgers. So when we are recording, then we have to create separate ledgers altogether. Okay, so I'm going to share the screens. I hope you'll be able to read the question as well as see the answer. Okay, so the question says on 1 August 2021, we've got an opening balance, and the opening balance is 3,750. So we come, remember it's an asset, it's a debit. So if our cash book is it's on the debit side, we also record on the debit side. If they say it is a credit, we also record on the credit side. So the receipt side is the debit, the payment side is the credit. So we record our date 1 August 2021, and then our description in this case, it's our opening balance. And our amount is 307.50. So with this opening balance, we are told that we also have retained earnings of the same amount, which means the debit is our cash, and then we've got a profit that we retained. So we create a retained, as part of our general ledgers, we create a retained earnings account that we create. And then because we have posted on the debit, then we are posting on the credit side. So our description, it's as well opening balance. And how much is it? 350. So when we come up with our trial balance, we find we are balancing because our debit and credit, there's something that is sitting there. And then on 2 August, we paid Telkom 750. Okay, let's assume we do not have an account with Telkom. They present their bill, we pay. Okay, it's 2 August. So it's a payment. I was making a mistake. It's a payment. So we are paying Telkom. And how much are we paying? 750. Let's assume they've presented their invoice on the 2nd and we have paid and we do not have an account with them. Then what we do in such a case, because we do not have an account, we received an invoice and we paid. Then what we do is that we record. We record under expenses. So we have our expenses ledger, and then we copy our T account. Remember, our T account is the same, records the same information. So you can always copy. If you're working in Excel, you are good with using Excel, you just copy the layout and then you delete the transactions. You name your ledger. And then in this case, it's our telephone. Let's call it telephone and internet expenses. So that if it covers our data, we know it's covered there. And what we have done in this case, we have paid, it's on the credit side. So to complete the double entry of our expense, we record it on the debit side. So this means that our expenses will always have debit balances. They are posted on the debit side. All our expenses are posted on the debit side. So this is bank account. So this shows that it's straight we are posting. It's not through an invoice. So if it was through an invoice, then we have to do a journal entry. Then we show that it was journal number 1, and it was we are posting a transaction for Telkom. And how much is it? 750. Okay. And then we go to our third transaction. 4 August 2021, we bought stationery for cash at CNA for 300. Because this is our, these transactions, we are told that they are for the business ledger. Even if it's written, we bought it for cash. So what we do is that we know that we are posting transactions for the business account. So what we do is we take it to the business cash book, unless if they are specific to say these are petty cash transactions. And then if it's petty cash transaction, then we know, okay, it's a petty cash. We are going to put it through the business cash book. So in this case, I think to say we bought it cash, it would mean we have swiped our card and then we've paid immediately. We don't have an account with CAN. Okay, so on 4 August 2021, we show we are paying CAN. And the other thing is that I forgot to say we indicate the account. So we are going to post it into our printing and stationery account, and then we show we bought from CNA. Even this one of Telkom, because we posted it to our telephone account, then we also show that it's going to our telephone account. So that when we are tracing, it's easy to go to the telephone account, we look for Telkom and the date, and then we are able to see the transaction. And then in this case, it's 300. So the same way, we then create a ledger for our printing and stationery. The assumption here is this is our first month of transaction, because if it's recurring, then you would have created your ledgers before. And printing and stationery. And in this case, it is the 4th. I hope I'm not too fast for you. I'm just trying to make sure that we cover all the transactions, because time seems to be flying. Okay, and the amount is 300. So this is our printing and stationery account. We have posted in the cash book, which is this one, on the payment side. And then on the debit side of the expense, then we post the expense account. Then we've completed our double entry. Okay, and then we paid a salary to the secretary in the amount of 46,000. So in this case, we take it as is. Usually, if ever there's any deduction, UIF deduction, or any other deduction that you're supposed to withhold, then would tell you to say the salary was 6,000, there was 1% UIF, or there was so much tax that is to be withheld. So when you go to your bank account, it would mean then you are not going to pay the full 6,000 to your secretary. You are going to withhold what is due to SARS, what is due to the Department of Labor, and then you pay your secretary the balance. Okay, so this one is a simple one. We are not withholding anything. We are just showing each other how to record. But when we give you assignments, like assignment 2, then you should learn to withhold. So it's salaries and wages. So in this case, we are paying our secretary. And how much are we paying? 6,000. So always remember, whenever we say withhold, it means you are paying less to the person, and you are supposed to do that. And to record the double entry, so then you create a salaries and wages account, then you record the 6,000. Okay, and in the next, I think in the next one, I will show you our next webinar. I will show you how to record properly the salaries and wages where they are where we are withholding money, because the salaries and wages account should show us the gross salaries, should show us the gross salary. So I will show you how to do it in the next webinar. Hopefully we'll get up to there. And then we are told that on the 25th of August, there was a withdrawal of 5,000 for the practitioner. So the practitioner withdrew 5,000. So it's 25 August. What we do, we put our date. I'm going to copy it, and this is on our drawings account. So it's our practitioner is drawing money. They're allowed to draw, and then how much are we drawing? 5,000. So to record this, the drawing account for our practitioner, we create the under equity, there is an account called drawings. So you find when we come to our equity here, then we put in our drawings account. So our drawings account would help us to record for the whole year how much our practitioner is withdrawn. But for tax purposes, you find we do not utilize that information. We do not utilize the drawings information. The taxman wants to know how much profit, so they always look at the profit. So that one you will learn it when we go further. So you create your drawings account. Even with partners, if they are partners, you create a drawings account for each and every partner. And then in this case, we record our date, which is the 25th of August. And then it's coming from our bank account. And it's our practitioner who has withdrawn the money. And how much is it? It's 5,000. Okay. All right, and then we pay rent. I'm not going to do the double entry for the rent. I think that one is easy. You'll be able to do it. I'm now in load shedding, and my battery is draining. Okay, we pay rent. So our rent account, there's no need for us to create a creditor, but if we do not pay in full, rather than we create a creditor, then it means we record the invoices, create a creditor, and then what we do is that whenever we pay rent, we do not post directly to the rent account. So that one I will show you in the next session, how we record our creditors. Currently, we are assuming everything went through the bank, we pay on time, and we don't have any credit owing for the rent account. Okay, so MST investments. So how much is it? 2,400. So like another expense, then we have to create a rent account, and then on the rent account, then we post the amount. And then the next one is we purchase a computer monitor. So this is an asset now, a computer monitor at Incredible Solutions. We are buying it cash. So if the policy is that it's supposed to be capitalized, then it's an asset. So under our computer equipment, It's monitor. We record it and then it's a payment, we've paid for it. So on our ledgers, we create a ledger as well for our assets. So if it's our first month or we have not bought any computer equipment, so it will be our first ledger. But where it's a continuous business, then you are posting on an existing ledger. There's no need for you to create a ledger each time you are creating a transaction. So that's how, all the things that are similar are posted in one ledger. That's how we record our transactions. So our computer equipment is on 25. If there's space, you can put in monitor and then you can show that you bought it from Incredible Solution, so that at least you can trace the transactions. They need to be easy. But if you record it by date, usually you'll be able to trace the transaction. So this is an asset. Our assets are always on the debit side. It's an asset, it's increasing value, so it's on the debit side. And then our liabilities are the ones that are on the credit side because we are owing, it's not our asset. And then we paid bank charges in the amount of 180. So it's a payment, payments on the payment side. And then it's our bank charges and how much, 180. So with the bank charges as well, we create a ledger for the bank charges where we record on a monthly basis. So as part of our expenses under the expenses ledgers, we record our bank charge just the same way that we're recording. Okay, so this is how we record our cash book. So your assignment 1, it is going to cover, it's based on the cash book. I don't think we'll extend it to the ledgers because we are starting. So you should be able to record in your ledger. So this is how you more of like record your ledger. So in this case, if you were told that you should balance your business cash book, so then when you look, already I've got balances. When you look at it, you would find the money that we had in our account is what less than what we have paid, which means now we are running on an overdraft. So our balance will come carried forward, will come this side. So in this case, let's calculate our overdraft. So on 31 August 2021, so we've got a balance. The balance that we are carrying over would be 11,679.99. But in our case, like our trust transactions, if it was the same firm, and then we are told that there's 15,000, like here, we were told that we took fees. Governor gave us fees of 15,000, and it's the same firm, then it would mean this money was received in our business account. So instead of balancing off, then it means we have to first of all record that money that Governor, what the fees from our client Governor. Then the status then changes altogether. So which means now we have enough, we had enough money for us to cover our payments, and our closing balance then changes, it comes to this side. So our balance brought carried forward, then changes, it comes to this side like that. You see? Then we are balanced. Okay. I think we can end here. If you have any questions, you will create the questions for me, and then we see in our next webinar, we'll be able to go further. Okay, any other questions? I think if you have any other questions before we say goodbye.
Can you take a snapshot, madam?
You want to take a screenshot of
Yes.
Okay, you can take a screenshot. You can take screenshots. What I will try to do, I will save our webinar workbook 1, and I'll also post it on our. Probably I'll do an announcement and then post the answer in Excel like this, so that for those who want to use Excel, you can then continue on a similar template. Is that fine with you guys?
Yes.
It's fine. It's fine.
Are you sure you won't include the ledger?
I want the ledgers will be there, because when I post, I'm going to post the full, like as it is.
Yeah.
Like I'll just post, it will be written webinar 1 workbook. So
No, I'm talking about the assignment, are you not going to include
the ledgers? No, I had not drafted it with ledgers, but if you guys feel like you want to practice more, you want it with ledgers, I can put in to say also include the ledgers. Because your assignment 2 will have, definitely it will come with ledgers, and assignment 3. Yes. So definitely. So thank you very much for your time. I know I've taken much of your time, but I know this is helpful, and if you can practice more, you'll be able to pass the course. Thank you.
Thank you very much, ma'am.
Thank you very much, ma'am.
Thank you very much, madam. Good night.
All right, thank you.
Thank you.
Thank you.
I will leave. Oh yeah, stop, leave.